Welcome to our third quarter MarketCast. It's been said that time is money, and it's true, whether we're devoting our time to our careers or investing our capital in the financial markets. But what happens when the time value of money suddenly changes? Like, for example, if the Fed raises or lowers interest rates. Well, over the past 2 years, we've been living in that scenario, and it's felt like we've been riding on an interest rate-driven roller coaster. For example, last year, the Fed raised the Fed funds rate by a whopping 4%, and both stocks and bonds had some of their worst declines on record. And then in the first half of this year, the Fed slowed down its rate hikes, and the markets had some positive results. But just recently, in the third quarter, the economy was running hot, and both the Fed and investors started seeing the need for higher long-term interest rates. And this shift in mindset drove investments down again. So what's going to happen next, and what's our strategy going forward? Well, let's start by looking at the numbers. As we see in the teal quarterly bars, investments generally declined in the third quarter. There were, however, some safe havens. Both Treasury bills and hedge strategies had positive returns both for the quarter and for the year thus far. And despite recent selling, stocks are up this year, with U.S. large cap, especially growth and technology, leading the way. But bonds have slipped into negative territory as the yield on the 10-year Treasury rose by 0.8% this quarter. That's the biggest increase we've seen in long-term yields in one quarter in almost a year. These higher yields come with a growing perception that the economy was outperforming expectations and that interest rates might have to stay higher for longer in order to bring inflation back down to an acceptable 2% level. But if rates rise, could that eventually choke off the economy and trigger a recession? Well, let's take a look at the path that our economy has been traveling on. In this chart, we plot U.S. growth and inflation over the past few years. The chart starts at a time of relative stability, the shaded period from 2016 to 2019, when GDP was growing in the single digits and we had inflation of around 2%. But then we can see how by June of 2020, the pandemic caused both growth and inflation to fall. That downturn was cut short when the Fed rate cuts and emergency spending drove the economy back toward higher growth and inflation. And then, seeing that inflation was starting to run too high, the Fed started raising rates at the beginning of last year, and inflation has since come down quite a bit. But now, most recently, the Fed and investors have become worried that rising wage pressure, oil prices, consumer spending, and government funding challenges might keep inflation from getting back down to its 2% target. And while those worries have led to higher long-term yields and lower stock and bond prices, FactSet is continuing to project relatively moderate growth and inflation for the United States through 2025. So does this mean it's a good time for stocks, or are bonds the place to be? To look into those questions, I'll turn it over to Research Analyst Nick Buckley.
Thank you, Glenn. I think a good way to get a sense of what's really going on in the economy is to look at the consumer, since consumers account for about 68% of our GDP. And looking at this chart, it seems like consumer stress is on the rise. Here, we can see that credit card debt has risen to a record level and that personal savings rates are near a long-term low. And adding to consumer stress, the average interest rate on credit card accounts has risen to over 22%, the highest on record. So clearly, consumers are feeling the pinch, and this could lead to a pullback in their spending in the next few quarters, which raises the question, are stocks and bonds fairly valued? Well, one way to value stocks and bonds is to look at their income yields. And here, we can see that after pausing in the first half of this year, bond yields are again rising sharply, while stock dividend yields have been holding fairly steady. This means that lately, the yield spread between stocks and bonds has been widening. In fact, at 3%, this spread is now the widest it's been since 2007. And while this yield spread may not be a perfect short-term buy or sell signal, we do think that stocks could be considered expensive compared to bonds. But this is just one indicator. Let's look at another one. In this chart, we see two lines. The teal line is the average investor stock allocation over time since 1951, and the gold line shows what the annualized stock return was over the following 10 years. It's important to note that the order of the numbers on the gold axis is inverted. This helps us see that historically, when investors held a lot of stock, future returns on stocks have tended to be low. And looking at the recent data, this chart also tells us that stock allocations are now hovering near an all-time high. So, if the historical relationship continues to hold in the future, stocks could face some headwinds over the next decade. Now, let's step away from stocks for a minute and look at some other types of investments, such as CDs and bonds. In this chart, we look back over time at what happened in the year following each historical peak in CD yields. And while it's impossible for us to know exactly when a peak in CD yields will occur, there are a lot of reasons to think that we could be getting fairly close to a peak. And if we are either at or near a peak, that's where this chart can be useful, because it shows that in the year following each peak in CD yields, both the Bloomberg US Agg and the 1 to 3 year government indexes have significantly outperformed the 1-year CD. That's because when interest rates decline, aggregate bonds benefit from their longer, roughly 6-year duration. But the opposite is also true. In a scenario where yields keep rising, then CDs or low duration bonds could be a better choice. And in fact, it's been our strategy to limit duration exposure as we wait for the yields on aggregate bonds to become more competitive with shorter term bonds and inflation. But we also note that bond yields have been very volatile lately, so over time, our view may change. And now, let's go back to stocks, which are a large part of most investment portfolios. Are they truly overvalued, or are there opportunities to be had? This chart shows the price to earnings ratios of various types of stocks. And what we see is that based on trailing PE ratios, US large cap stocks look expensive relative to their long-term averages and global equities, while US small cap stocks appear inexpensive. We also see that international stocks typically trade at lower PE multiples than global stocks, and they are currently trading at a discount to their historical averages. So, in a nutshell, based on PE ratios, it looks like there is a major valuation split in the market, where US large cap stocks look expensive and everything else looks neutral to cheap. In fact, so much so that it feels reminiscent of the 1999 tech bubble, which makes us wonder what would have happened if we bought the 10 biggest tech stocks in 1999. How would it have worked out? Well, here are the top 10 tech stocks of 1999 and their annualized returns over the next 23 years. And we see that 9 out of 10 of these stocks wound up lagging the S&P 500 index over the next 23 years. And you may wonder, where are Apple and Amazon? Well, neither Apple nor Amazon made the top 10 cut in 1999. Amazon would have ranked 23rd, while Apple ranked 30th on the list of most valuable tech stocks at the start of 2000. So, after 23 years, the median outcome for this top 10 list was a 61% shortfall in eventual wealth relative to an investment in the full S&P 500 index. And this is why starting valuations are so important to long-term investors. It's a big part of why we prefer to steer away from today's high-priced, large-cap growth stocks. So now, to put all of our ideas together, I'll turn it back to Glenn.
Thank you, Nick. When it comes to our tactical views, as Nick pointed out, we're currently taking a cautious view toward the aggregate fixed income area. Instead, we favor cash and low duration for their income and for the stability that they provide. We continue to like hedge strategies for the risk management and as a source of dry powder for potential future equity purchases. In the equity space, our overall view is neutral. We continue to diversify across all asset classes, but as Nick said, it's our preference to tilt away from this year's high-priced growth stocks and toward more reasonably priced small and international stocks. But as always, we note that markets are dynamic and our views may change. Your advisor will work closely with you on specific opportunities as they become available. Please keep an eye out for an invitation coming soon to register for our upcoming November 9th live webinar presentation, Property Transfer Solutions, Maximizing Outcomes from Real Estate Sales. Special guest experts on real estate investing and real estate taxes will discuss options and solutions for exiting from property, whether you are transferring to heirs, selling, or seeking other alternatives such as charitable remainder trusts. We look forward to seeing you there. Thank you very much for joining us today.